Let me explain to you something. Why do some people make money while sleeping, while others work 9 to 5 their whole lives? The difference is ownership. In this video, I'm going to explain stocks in the simplest way. I'm going to explain to you what they are, how they work, and how you can start investing smartly. What is a stock? A stock is a small piece of ownership in a company. When you buy a stock, you're not just buying a number on a screen, you're becoming part owner of the business. So now, once you become part owner of a business, if the stock is doing well, for example, if you bought an Apple stock or a Tesla stock, if they are profitable and they are giving out dividends, you then become, because you're an owner and you hold the stock, you then receive dividends. How do you make money from stocks? There are two main ways to make money from stocks: capital gain and dividends. So let's start with capital gains. Capital gains is if you buy the stock at $1 in the beginning of the year, and at the end of the year it becomes $1.30. You've got a capital gain of 30 cents. So now dividends, the way dividends work is, let's say you own that stock, let's say you own one stock, and then the company does well and is profitable. They're going to pay out something called a dividend. So they're going to give you a share of the profits as dividend. So maybe one share can be worth maybe 20 cents. So that 20 cents will be the dividend that you receive. Why does the stock market move up or down? So the stock market moves up or down because of supply and demand. So the way the stock market works is it can move up because of economic news, interest rates, the economy itself in general. So the stock price can it goes up by psychology, by the psychology of investors. So if investors feel that this stock is going to go up, it will create demand and then they'll buy it. And it's also part logic. So maybe the fundamentals of the company can make it go down or up. So the stock market goes up because of supply, basically because of supply and demand. Let's talk about risk and reward. So risk and reward depends on how risky the stock is. So let's just say, for example, the company that you're buying the stock from is a new company. It will be a high risk stock, but it has a high potential of reward. So the higher the risk, the higher the reward. But if it's a stable company, it will be a low risk stock. However, the reward is less. So the way you manage risk and reward is diversification. So instead of you just buying one stock, you can buy many stocks so that the overall risk is stable. So what is an index fund? So an index fund is a bundle of companies. It's a number of companies that are bundled together. So instead of you just buying one individual company, you can just buy a bundle of companies that are bundled together. So let's just take, for example, the S&P 500. S&P 500 is based off 500 largest companies in the United States. So this helps diversify your portfolio and also manage risk and reward. So what is short-term investment and long-term investment? So long-term investment is when you buy and hold a stock or an index for a long time, for example, for maybe 10 years. And then short-term investment is when you buy and hold maybe for a day, a week. But historically, the data shows that the long-term investor performs better than the short-term investor. What are the common beginner mistakes that people do when they are investing in stocks? So normally the common beginner mistakes is they buy stocks depending on hype on social media. They sell the stock when there's a drawdown or when the stock price of that stock goes down. Another mistake is they invest money that they're not willing to lose. So maybe you're investing money for your rent. You can't do that. So the stock market rewards those that are patient. So like I said earlier, long-term investors. So you need to invest for the long term. In conclusion, stocks are not gambling, they are just ownership. So if you are going to invest in stocks, like I said earlier, invest in the long term. Do not use money that you cannot afford to lose, such as your rent. You need to save money. And then, but like I said in my other videos, that saving and putting money in your bank is not good, as there's inflation. So you need to invest in stocks, but invest them in the long term. So guys, if you enjoyed this, please like and subscribe and click the notification button so that you can get more of these concepts. Thanks guys.